All right, guys, let's talk about what is good debt and what is bad debt. So normally when I talk about debt and how young people and people in general need to avoid being in debt, I am typically talking about consumer debt. Debt that involves you taking out loans for things that are going to get used and have no long-term value. So this refers to cars, student loans, credit cards. I guess you can say those are the big three. On the other hand, good debt can be considered debt that holds value over time on assets, or I guess debt that is taken out for assets that hold value over time. So of course, this includes homes, assets in the stock market, anything that holds value that is considered a true asset. And a lot of people like to think that cars are assets. In a sense, they are, but they're depreciating assets. They're going to lose value over time. So taking out a loan for a car is not necessarily a profitable decision. Whereas if you take out a mortgage and the home appreciates over time, which it will do because the economy is always going to inflate our dollar, your home price will eventually outweigh what you originally bought, no matter what, unless you move somewhere that's going to blow up from a tornado or something. And the key to getting really wealthy, I guess, is learning that everybody in this system uses debt. But if you're going to be somebody who uses bad debt as a consumer, that's how you stay poor. Rich people, most of them have debt as well, but they have debt on objects or assets that hold value and give them money in return over time.